Okay, good morning. I hope you're all well. Final week of the month begins, and important, pretty extraordinary end to last week. Just before we touch on that, oil's the big mover here this morning, coming sharply off that top. I mean, it's just it continues to be an extraordinary year for crude oil. Looking at this move at the back end of last week in percentage terms, you're getting a lot of people basically talking about how oil is now in a bull market. Technically, what that means is if oil rises 8% off recent lows, then you're officially in a bull market. Well, we didn't quite make that. 18.8% up. That's the distance between Wednesday's low, Wednesday afternoon, through to, if you just take Friday's high, actually, so basically in 48 hours, oil rallied almost 19%. You're getting a sharp pullback here. Now, we've got key support around this area. The pivot level, which is also this top from the beginning of last week, the 19th of January's top at 31.36, and the pivot level, we've had a very strong test of it there. We did slide about 10 ticks or 10 cents or so below that. We're just lifting now. I mean, this is a very important technical level, certainly the most important technical level this market has encountered on the way down here. But this is a big move off the top around about 6 a.m. That's $1.50 to the downside quite sharply. Of course, this is just giving back some of the extraordinary moves to the upside that we had the back end of Wednesday's session, just around the European close, and then adding to it throughout Friday. I mean, Friday was just one way for the whole session, and that way was to the upside. So, oil will of course continue to dominate. If you look at the equity space, then as oil has been dropping, well, then equities have been dropping, and equities had a great run into the downside here for the DAX. We didn't quite get back there to Friday's low. But oil leading the way, the S&P just coming off a little bit. We, of course, hit 1900. Let's have a look at the S&P. Very, very correlated. The oil markets and the equity markets last week, very strong positive correlation. Big dip into Wednesday's low, with the S&P, of course, almost hitting 1800. Then a 100-point rebound. Again, in basically 48 hours. Just phenomenal distances being covered. And look at last week. You start off here on the 18th of January. We start off around about 1870. We drive strongly up to test the 1900 handle. We then sell off 100 points sharply into Wednesday's low, then bounce 100 points. I mean, well over 200 points were covered through last week's price action. Quite phenomenal stuff. If you look on the weekly chart, then we were talking about this at the end of last week. We were talking about the fact that once the market started to bounce on Wednesday, we were talking about the fact that it would be pretty crucial if the bulls can somehow pull off an up week. And they managed not only to do that by getting back up above the opening levels at 1870, but also getting right up to 1900. The close came, unfortunately, just a couple of ticks shy of that 1900 handle. But first up week of the year, you can see we kind of encountered a bit of resistance around the 1900 handle, which was important. If you go back to August, after August's volatility, the really sharp sell-off, really strong rebound. We then found support at 1900 a couple of times, August, then September, broke it briefly in October, but 1900 still carries some significance because it's such an important handle, of course. And so we begin this week right on the 1900 handle, oil sliding this morning, just taking us off those highs. So it'll be interesting this week. I think the first 2 weeks, and certainly the first half of last week, it was a bit of a no-brainer trying to predict direction. Sentiment was so heavily negative that it was inevitable we would get a continuation of the decline. But the reaction in the second half of last week, I think, now makes directional calls very difficult. I think the start of this week, it's kind of flip a coin stuff. at this point, I would say. Now we're back at 1900. Where do we go? Hard one to judge. I'd say if you're looking at the daily chart, well then really, really sharp rebound. And let me just actually, I need to adjust some of these lines. Let's just stick a level in here at last week's low. But very sharp rebound. But you would say we are kind of still in this downward trajectory. I mean, you on many kind of measures, we're still in a downward trend. And I think 1900 is an important handle for determining whether the trend is really finished or not. And I think today 1900 is key, and we'll see how we get on. But there is a lot of stuff happening this week, so we may well get back to more actual fundamentals rather than sentiment-driven markets. Panic and fear, that's really what dominated the year so far. And perhaps we'll get back to looking more at the actual numbers. On that front then, I mean, if we just had a look at the calendar, it is a packed week, but with lots of different types of kind of news flow. Let's have a look. So hang on, let me just get a screenshot up here. I'm going to show you let's start with just today's calendar to begin with. So important data at 9 a.m. this morning from Europe. We've got the German IFO data, the business sentiment number. It's expected to be at 108. I'm going to just bring up a chart, actually. Sorry, I didn't prepare the chart, just to get that in perspective. With any of this data, you should never go into a data release without actually looking at the chart. How has this data release performed in recent times? There's no use just going in knowing that last month it was 108. I mean, you got to be able to put these numbers in perspective. Here's the chart, 108.7 last month. So you can see from this chart we've had a very solid sort of 9 months of strong numbers. So key numbers on the upside, something very impressive would be above the 109 level. That was the November high. If I show you back on a 5-year chart, basically above 109 would be a 9-year high. To make a 9-year high, 9-month high. To make a 5-year high, we need something above 112, right? But of course, these are business climate. This is a soft data. This is a sentiment data, and given the negative sentiment surrounding financial markets, at least over the last couple of weeks, you would perhaps expect German business leaders to be a little bit more nervous about the future. With China risk escalating quite sharply, you would have to assume it's got to be inevitable that this climate sentiment number suffers as a result of that. You're certainly getting, I would say, traders of the mindset going into this figure that this data is going to drop quite sharply from last month to reflect this sentiment. If it does stay in the 108, if it gets above 109, then that would be all the more surprising. Okay, so positive upside surprises will probably carry the most market reaction, but the most likely scenario is a drop off last month's highs, and therefore, anything down below 107, and you can see we're getting back to levels we haven't seen since the start of last year. Okay, anything below 107, certainly anything below 106 would certainly be bad news. Okay, so that's the German IFO number. That's next up at 9 a.m. Actually, probably arguably from the economic data point of view, that's the most important number of the whole day. You can see after 9 a.m., and we got some Italian stuff in here as well. But after that, there's actually nothing. There's no US data other than the Dallas Fed manufacturing number, which is certainly not a headline data release. So actually, this iPhone number is pretty much as good as it's going to get from an economic data point of view. Just scrolling down. Now, we do have Draghi talking. That's not until after the European close, but bear in mind he was very busy last week, both at in Frankfurt, the European Central Bank press conference, but then also in Davos. And of course, Draghi is responsible for some of that move into the back end of last week. I mean, what drove that risk on, or not? You can't call it risk on. What drove the rebound, the relief rally, let's call it, is twofold. Yes, it's oil rallying strongly, almost 20%. That's definitely probably the biggest catalyst to that upside move in equities. But it's also Draghi trying to be supportive, trying to do what he can to improve sentiment. Well, I don't know. I think the market overreacted to it. That's my personal opinion. I think the markets were desperate for some kind of good news, desperate for anything to improve sentiment, and over needy. That's what markets are. And I think they read too much into Draghi's statement, which essentially markets took as him promising more. I mean, talk about short memories, but he promised more in October and spectacularly under-delivered. Now he's promising more in January. Why do you think he's going to deliver it this time? Don't forget, you got Weidman on the committee. Trying to get stuff past him, well, it's trying to get past Hugo Lloris. It's almost impossible. So that helped with the upside sentiment at the end of last week, certainly. Now let's talk about earnings, because this is one big. Well, actually, before we talk about earnings, let's just cover the data set that we've got this week. It's a busy week, last week of the month, of course, and busy week for data. So let me just quickly zoom through, if I can find my data calendar. Give me a second here. So yeah, I'd say probably today is the quietest day of the week in terms of data. But tomorrow, stuff like, well, pretty quiet in Europe, but stuff like housing data in the form of FHFA, house price index, Case-Shiller numbers. We get the composite PMIs, flash estimates from the US. We get the Richmond Fed manufacturing number. So a busy afternoon without any of that being necessarily kind of headline stuff. In China on Wednesday, we get industrial profits numbers. We get consumer sentiment data. That's the only data of the week from China. Of course, still keeping eyes on the yuan, still keeping eyes fully on the fix at the start of each day, all through last week, and certainly helped. I know midweek last week, stocks hit their lows, but China's central bank did keep the exchange rate unchanged throughout the whole of last week. And that has continued this morning, okay? So we've got to keep our eyes on what they're doing with their currency, also keeping half an eye on any stimulus. I mean, you never know, a rate cut might be imminent, so keep your eyes out for that. The big event on Wednesday, of course, is the FOMC meeting. I say big event now, there's no press conference, so all we'll have is the statement delivered. And I'm just watching oil, which has actually just broken this level, well, not just, over the last few minutes. So oil continuing to slide here. That's 3.4 down on the session now. Breaking back down below 19th of January high in the pivot level. You've got 31 handle is kind of next up. You could also, we had a bit of resistance Friday morning at around, around here. So the next support is down around the 31 handle. We'll just put in there on Twitter, we're getting news. Maybe this is driving it. I was looking around for news on this move lower, and I couldn't really find anything this morning, and so just assumed it was some short-term profit taking, anybody enjoying the rally back end of last week, or of course it's people, it's short the bounce kind of strategy. That's how you trade a downtrend. So a phenomenal bounce, of course. So you might well just more positioning on the short side. But we had news on Iraq. Oil production in December was at a record high. That continues the theme of last year, by the way. Iraq producing record amounts throughout the year. Of course, OPEC are producing at least 32 million barrels a day, exacerbating the oversupply, of course. So oil just, very sharply giving back a massive chunk of Friday's 10% rally here. More on the data front this week. Then we got stuff like Q4 GDP from the UK. We got a whole bunch of data out of the US. We got Eurozone CPI on Friday, German CPI on Thursday. We get US Q4 GDP as well at the end of the week. Chicago PMI, University of Michigan sentiment numbers. So the back end of the week's pretty busy. And then the other big feature of the week, of course, is the earnings season, which, really this week properly hits full stride. We've got 134 S&P 500 companies reporting this week. It's kind of tech week. A lot of the tech giants, Apple, AT&T, Facebook, Microsoft, Amazon, they're all on the slate. You got McDonald's, you got Chevron on Friday. Of course, all eyes still on the energy sector earnings numbers. And so we will keep an eye on the earnings front. Yeah, I've just seen Alan talking about Snowmageddon, the second worst snowstorm in the history of the US. Hit New York and, well, the East Coast generally over the weekend. I'm sure you saw the pictures. This kind of helped, I would say, with the upside on oil in the last week. The threat of this violent snowstorm hitting and the energy requirements that would be needed in cold temperatures certainly helped, I would say, on the upside last week. It's just that, I guess, the storm's over, but, I mean, the snow's still there, but, maybe that was helped along with that dramatic bounce on crude, and now that bounce was just being used as an opportunity to get short. I mean, maybe let's just finish. I said it's difficult to pick direction on stocks now, and I would say with oil, certainly from a trend point of view, it's still we're still heavily deep into a downtrend. Even with it's kind of crazy to say that when we had almost a 20% bounce in 48 hours, and you still say we're deeply in a downtrend, but it is true. It's a fact. I mean, I'd say the price point, the December low here is 34.29. I'd say that's huge, that level, and we'd need to get back above there to be confident that a low's been put in place for now. And so, of course, we didn't get anywhere near it on this bounce. We didn't even get above the 33 handle, never mind above the 34 handle. So we're still very much in a downtrend, but this bounce was so strong that I think you're going to get people being a little bit more nervous
in 10 minutes
about
time we do have the release of
picking direction. So you might get a bit of consolidation over the next couple of days. Of course, stuff like the Department of Energy inventory data on Wednesday is going to be a key guide. But I'd say it's quite tricky now this week, having had very one-directional markets for the whole year. It might be a little bit more challenging. I think momentum in any one direction is perhaps going to be less sustainable. So it might be a more tricky week. Maybe it's going to be a week more for you range bounders rather than you. All right, let's get on with it then, because we've got German IFO in 8.5 minutes time, and we'll see how we get on through the week. Enjoy the session.